Welcome back to part 2 of building the structure. In the last video, we looked at the accounting perspective of the balance sheet, and we understood this layout of liabilities and assets and how they must equal each other. We're going to step forward now into looking at a more business-orientated perspective. And what you'll notice here is that the income statement is effectively the same as the accounting perspective. No real change there, but the change appears in the balance sheet. So if you recall this formula that came up in part 1, assets is equal to owner's equity plus liabilities. We can expand this formula so that the fixed assets and the current assets, the sum of our assets, are equal to the money from shareholders, the long-term debt, and the current liabilities. Now, if we were to go down this equation and ask each item where they fit into the business, and when I mean fit in, I mean, are these items part of the operations of the business, or are they part of the capital required for the business? Okay, so let me repeat that again. Are they part of the operations, or are they part of the capital required? So if we think about the fixed assets in the business, this is the production equipment. This is the vehicles that form part of the Avis fleet, if you want. These are the buildings that a landlord might lend out or lease out. These are part of the fixed assets, and I've put this circle around here that represents an O for operations. In other words, fixed assets are used in the operations of the business. And when we look at the current assets, remember this is the stock on the shelf at Pick n Pay. This is the cash in the bank. It's also the money that our customers owe us. We call that debtors. This is part of the operations. And specifically here, if you think of the stock on the shelf at Pick n Pay as part of the operations, then that for me is the best example I can give you of how this is part of the operations. And if we ask about the money that comes from shareholders, this is a source of capital. This is money that we need in order to buy these assets. And the money that comes from the bank, we called this debt earlier, long-term liabilities. This is also a source of capital that's required to purchase these fixed assets in the business. And that leads us to this next component, the current liabilities, that we need to ask ourselves, is this part of the operations of the business, or is it part of the capital? Now, I'm going to suggest to you that the current liabilities is largely made up of money we owe our suppliers. And the suppliers are critical to the business in as far as they support the operations. So that's why I've put an O around this, to suggest that this is part of the operations. Now I'm going to rewrite this equation so that these current liabilities come across to the other side and are therefore now part of the operations. And note how the sign changes from a positive to a negative. So I've just rewritten this, and here on the right hand side now what we will have is the equity and the debt, and we can say here's the operations and here's the capital. We can go one step further and just circle up around the CA and the CL, and we're going to call that the working capital. So let's build a balance sheet that reflects this equation. Here we have some debt and equity. It's what's in the box here, owner's equity plus long-term debt. And on the right hand side, we're going to have some working capital, CA minus CL, and some fixed assets. And we're going to name these total capital, E plus D, total capital, sum it up. All right? And net assets, fixed assets plus current assets minus current liabilities. And we're going to refer to the left-hand side as the capital, sources of capital, shareholders and banks that fund the operations of the business, fixed assets and working capital. We're going to do the same thing or very similar thing in the income statement. I'm going to draw this line in here underneath the profit before interest and tax, and if you recall, I called that the operating profit, which says that the components above this line all relate to operations, and everything below this relates to capital. So if you think about the sales in the business, we're trying to generate as much of that as possible. We've got some cost of sales. This is product that's produced using some fixed assets. Will give us a gross profit. We've got some people that are working in our business in order to produce a profit. All this stuff is operations, and everything down here, interest relating to debt and dividends relating to shareholders, that is all part of the capital of the business. If we put these two balance sheets side by side, here on the left we have the accounting perspective that talks about liabilities and assets, and here we have the business perspective that talks about capital and operations. And really all we've done here is we've taken these current liabilities, we've moved them across to the other side where they get a negative sign in front of them, and hence we have a working capital number. We are going to spend time understanding financial statements by using the business perspective. The reason for that is it's not my intention to turn you into an accountant. I want to give you the tools so that you can understand business performance and speak the language of business and make good decisions using financial information. And I think that is best achieved using a business perspective. And having taught this for many years and having had a lot of feedback from students, they have said to me it's this perspective that helped them really understand this subject matter. So there we have it. Two parts, looking at the income statement and the balance sheet. In the next video, I am going to get into some numbers and a spreadsheet and showing you how all the numbers fit into the different boxes that I've described in this building the structure lecture. See you on the next one.